Addressing the market expectations mismatch here. It's a tighter than expected labor force, likely to lead continued Fed hawkishness and may clash with investor expectations of a Fed pivot soon. So joining us with how this will affect the outlook for markets heading into 2023, we've got Scott Wren, who's the senior global market strategist over at Wells Fargo. Scott, great to have you here with us, and an early happy new year to you as well. I mean, we've discussed at length going into 2023 what some of the expectations are, but what are some of the key indicators that you would be keeping a close eye on even as the new year strikes and as we start to hear more inclination about what the Fed's policy pathway will be?
New Year as well. I think some of the things that you want to pay attention to, we know the Fed's watching the labor market, so you want to not watch initial jobless claims. That number is going to climb, at least in our opinion, and certainly the Fed wants it to climb. They want a weaker labor market. We think we'll see about 5.2% unemployment by the end of this next year. And then another thing I think you want to watch are earnings estimates. And in our opinion, we have a $205 number out there for next year for the S&P 500. I haven't looked at the consensus in a while, but I think it's probably around 230, 235, something like that. So in our opinion, these earnings estimates are going to come down. We expect a moderate recession to start, pretty soon after the new year and maybe last mid-year, June, July, August, something like that. So I think as far as the key indicators, you want to watch earnings, you want to watch the labor market. The labor market's going to tell you what the Fed's going to do.
Scott, boldest predictions for stocks next year?
We think we're going to see 4,400. That's a 15% return from where we are right now, excluding dividends. So overall, we think the second half is going to be pretty good. The Fed's probably has some rate cuts in its pocket in the second half of the year, which I think is I'm not sure if that's totally non-consensus, but we're expecting about 75 basis points worth of cuts. And so we're expecting a strong second half, and we want people to take advantage of the volatility, probable downside volatility that we're going to see here in the early month, 2, 3 of the new year.
Scott, let me follow on that. How many rate cuts do you see in the cards next year?
We have 3 25 basis point cuts penciled in the second half of the year.
Okay. Also, S&P 500 expectations. FactSet certainly right now has been holding on to 5.5%. Do you believe that we need to see some earnings guidance start to come down?
I think we will. And, the problem with individual company analysts is that, now in this day and age, they wait for the company to tell them what to do with their earnings number. Because believe me, if you're an individual company analyst, you call the CFO, you want to talk to him, and your earnings estimate is out of range, he's probably not going to answer your call. So individual company analysts tend to kind of stay in line with where the company wants them if they want to have any communication with that company. So I think you're going to see some earnings estimates from the companies themselves start to come down, guidance come down, and that's when you're going to see the individual company analysts come down. You cannot wait for that. You have to anticipate whether that's going to happen or not, and we're anticipating that it will happen.
Do you see earnings declining next year?
Oh, we do. Not by a lot. We've got, we think we'll come in at about 215 this year in the S&P 500. We've got the number next year, as I mentioned, at 205. So, 4 or 5% earnings decline. Not a lot, less than what you'd see in a normal average type of recession, but a contraction nonetheless.
Okay. What are the sectors that you would be tracking and are tracking right now? Has there been any rotation in your own strategy, perhaps even in the final moments of 2022 going into 2023?
Well, I'll tell you, this is what we've been doing really March, April. We made some moves. We've been a lot more defensive, a lot less cyclical, a lot less sensitive to the ebb and flow of the economy in these portfolios. And so, we've liked things like healthcare, and we've downgraded small cap, emerging markets, consumer discretionary, industrials, things that are sensitive to the economy. We're not looking to get more defensive. The conversations we're having at an investment strategy committee level are, when do we get more assertive? What's the timing on that? Normally the market bottoms out and starts to turn higher about halfway through a recession. So things like small caps and consumer discretionary and industrials and financials and high yield bonds, they start to do better. Those are all early cycle outperformers. So for us, we're trying to figure out, when do we go from defensive to something more cyclical where portfolios will benefit from the recovery that we anticipate as we move through the second half of the year and into and through 2024.
Scott Wren, Senior Global Market Strategist at Wells Fargo. Good to see you. Have a happy New Year. We'll talk to you soon.
Happy New Year, guys. Thank you.